Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Please welcome back Peter Boockvar. He is the Chief Investment Officer with Bleakley Advisory Group. Peter, it's great to have you back.
Thank you, guys. Appreciate having me.
Hey, so Peter, there's been a lot going on in the news in recent days. We've seen the European Central Bank, I think, what were they at? Negative 50 basis points. They just raised rates to fight inflation. So now, surprise, surprise, they're up to 0% to fight inflation. So is this for real? I mean, would you have expected more, or how, do you really take this seriously?
No, they're of course not a credible central bank when it comes to dealing with inflation, but the ECB for the last 10 years has really just been an arm of the Eurozone governments in financing their debts and deficits. QE started in Europe not because there was a deflation worry, even though we shouldn't necessarily worry about deflation. It was to bail out Greece and Italy and Spain and Portugal. So then Draghi took that as, okay, well, we're doing that, whatever it takes. But then all of a sudden that morphed into, okay, let's try to raise the rate of inflation, which is tough to do when you kill your banking system with their policy. But they've essentially become an arm of these governments. So they talk about price stability as being their sole mandate, but we know that it's morphed into something else. And that is also highlighted by this new TPI, transmission protection instrument, which is basically another way of saying it's an Italian government bailout instrument in case their yields widen out too much against German bund yields.
Yeah, that was the big thing. I think at one point a couple of years ago, before they start, Mario Draghi's, anything, whatever. What was the official quote? We'll do anything it takes.
Whatever it takes.
Whatever it takes. Italian debt, went up to something like 7 or 10 or some really crazy high number of percent.
Yes.
And essentially, Italy would have failed if that had continued. So they have to buy their debt to keep interest rates artificially low.
Well, it really started. Yeah, they started by bailing out Greece, and we know that Greece restructured or termed out a lot of their debt, and then of course Italy, being the largest bond market in that region in terms of the size of the debt they have, was obviously also something that Draghi bailed out too, of course, because that's his hometown team too.
So now Italy's on the verge of having another crisis, correct? Now the European Central Bank, they want to get tough on Italy, and from what I briefly read about this TPI, this anti-fragmentation tool, there's going to be some strings attached to it in terms of certain fiscal policies that the countries have to follow in order to be eligible to have their debt subsidized by the European Central Bank. But is that all just fictional? I mean, don't they have to buy the debt? They don't really have any choice. Otherwise Italy falls apart, right?
That'll eventually be the case. They had rules of wanting members to keep their budget deficit no more than 3% of GDP, and that was obviously flouted. So I'm sure when push comes to shove, if the Italian 10-year goes to 300 basis points from about 225 now, and if they don't meet all 4 criteria, I'm sure the ECB is going to put the criteria aside and start buying up Italian bonds. So while again she laid out that checklist, I think when push comes to shove, I don't know if she's going to expect every box to be checked before doing something.
But silver and gold had an interesting reaction this morning. And just so the audience knows, we're recording this on Thursday. It had initially, when they raised the rates 50 basis points, I think you made the comment, it was down 20, gold was way down, and now it's totally flipped around. What happened this morning?
So the euro initially rallied a full dollar after the rate increase of 50 basis points. It since gave back a lot of that, but with that rally in the euro and the weakness in the dollar, gold did reverse to the upside. And I would say 50 times over the past couple of years, I've tried to call bottom and gold and hasn't worked. But maybe this time is for real, because other central banks are getting tough in trying to tame inflation. And even though the ECB has rates only at 0, it was a 50 basis point increase instead of 25. The Bank of England in August is going to raise 50 instead of 25. Swiss National Bank surprised us with 50 when they met at their last meeting. The Bank of Canada surprised us with 100.
Yeah.
The Reserve Bank of Australia surprised us. The Bank of Korea raised 50 for the first time since they started setting rates in the late 90s. Usually it was 25. So other central banks are also getting aggressive. And if you believe, like I do, that a lot of the dollar strength has been more predominantly due to interest rate differentials and the aggressiveness of the Fed relative to others. Now, granted, Europe obviously has its own issues, and the yen has its own problems with Kuroda's policy. But I think broadly speaking, if other central banks are going to be more aggressive in raising interest rates, it will be a test for the dollar if interest rate differentials was one of their main reasons for its increased value. And we'll see. I thought that things would change after the Swiss move, but of course, worries about natural gas coming into Germany was more of a focus. But we'll see whether that changes now, because also this is coinciding with Russia turning back on Nord Stream 1 for the region, particularly Germany, and we'll see if this lasts.
Yeah, that's a big question, Marcus. Yeah, it's on, but it's on at like 20% of normal. So we'll see if it's funny. Natural gas prices in Europe are up, 600%. So Russia still collects the same amount of revenue, just sending 20% or more revenue, sending 20% of the natural gas that they used to. So it's
right.
kind of it's like his incentive is just send them a little, just to keep the revenue flowing in, but keep starving.
Yeah, I mean, I think he can't cut it off completely. Well, he can, of course, but I don't think he wants to, because he still realizes that Europe's a big customer, and to further inflame this situation would be even worse. He can just play games with them while still maintaining them as a customer.
But you on your website, I want to pull something up here. You recently tweeted out this chart, the 6-month business outlook of the Philly Manufacturing Index. Why is this important? What are you paying attention to in this graph?
So the regional manufacturing surveys, we saw the New York one last week and Philly this week, and we'll see some more in the coming weeks. And it's sort of a precursor to the national ISM and also the national PMI from market. And it's just another piece of sort of the economic matrix of trying to figure out what's going on. And this is reflecting the 6-month business outlook falling to the lowest level since 1979.
Yeah.
And when you break out the US economy in its individual pieces, we know there was a spending binge for goods over the last couple of years in in the COVID world, where you had, on one hand, a lot of money being sent out to people. And what did they spend the money on? Well, it was certainly not travel and leisure and going out for dinner. It was on other things like exercise equipment, redoing your kitchen, painting your deck, or whatever. So now we're seeing excess inventories building up in some parts of the goods side. Walmart, Target, and other retailers talked about that when they reported earnings within the last few months. And we're also seeing a deceleration in the rate of change in goods prices. So I think that this just is showing you that a combination of that sort of hangover, that good spending hangover, in addition to in high prices, that's also negatively impacting consumer spending. And we are on the cusp of the manufacturing recession. Also, global trade has obviously slowed. A lot of these US manufacturers ship stuff overseas. So I think that this is a warning that at least this sector of the economy is softening notably, on top of housing, which we know is softening as people are buying less homes. because of the high cost of them, in addition to the high mortgage rates. And I think it's just another piece of the recessionary puzzle that we're putting together here.
Another chart that you posted recently this is on your website, is the unemployment claims. Those are starting to tick up again.
Yes. So on an absolute basis, the around 250 is a modest pace of firings, but as seen in the chart, there's a clear move in the trajectory of claims, and that is higher. So initial claims this week got to the highest level since November. So this is a 7-month high in the pace of firings. So this is notable also as part of this recessionary matrix that's coming together, and that the labor market, which is a very lagging indicator, was being used as the crutch of the Federal Reserve, thinking that they can get away with very aggressive monetary tightening because the labor market's strong. Even though all one has to do is look at history and know that an economic expansion usually ends when employment is at very low levels, and they usually start expanding again an economy when often an employment rate that's usually very high. It was maybe it was last week that Governor Waller, in an interview, was like scratching his head. It's like, I can't understand how we can go into recession with the unemployment rate of 3.6%. And I'm thinking, this guy obviously just has no sense of economic history if he's going to make that comment.
I've seen in certain media articles, they were saying technically a recession, but because the job market's so strong, it's not a real recession. I mean, I literally saw articles like that in the past week or so. And I've seen so many articles of companies pulling back on their hiring. A lot of tech companies, Microsoft just yesterday, Facebook is pulling back dramatically.
Ford today, they cut
Ford
8,000.
another 8,000.
Yep.
And Zuckerberg from Facebook, he's literally trying to talk people into quitting, with some of his comments.
Are the allegations true that you are secretly a lizard? I'm gonna have to go with no on that.
It just a lot of these open. One of those other statistics of jobs open. I mean, that can disappear in a heartbeat as companies just cancel all their openings online,
Right.
as you're starting to see.
Yeah, and one last point on the job openings. Reading more about the possibility of even that number being inflated, and that if in this new work from home, work from anywhere environment, if I'm a company based in Nebraska and I'm looking for employees that can work from home, well, I may be placing job ads in 5 to 10 different cities around the country. It's really one spot that I'm trying to fill,
Right.
but it shows up as 5 to 10 job openings.
I had not considered that. That probably is happening to some extent out there. But it's probably impossible to measure how much that's happening. But yeah,
It's very difficult to quantify, but
Yeah.
it's becoming apparent it's happening, but don't know how to pin down its direct impact on that number.
So how would you interpret the Fed's likely actions going forward for the rest of the year? I think when the next GDP number comes out, it's probably going to be a negative GDP print. If you look at the Atlanta GDP now, it's I've been between -1% to -2%, fluctuating around there the last few updates. So we're likely to be in a recession by the end of this month officially. And would then the Fed still keep raising rates in the face of that? I mean, I think most people agree we have another 100 basis points baked in, right? They're going to do 75 or 100 at the next meeting. But do they keep going beyond that, even with a recession going on?
I think the Fed will tolerate a recession. What they will not tolerate is a short rise in the unemployment rate. Now, of course, the unemployment rate is going to rise in a recession. But if it goes from 3.6 to 4 or 4.5, I think that's something that they'll be able to tolerate in their goal of bringing inflation down as quickly as possible. But if 4.5% quickly becomes 5, 5.5, I think that's when all bets are off with respect to their tightening. Now, they'll raise 75 next week. I think they'll want to get another 15 in September in order to get the Fed funds rate to 3. It would be 275 to 3. I think that's the ultimate goal that they want, because if they get there, they can then sort of take a breather
Right.
in either in raising or at least moderating it down to 25 and see what the state of the world is like. Because all these central banks outside of the BOJ is raising rates. So there's going to be an obvious economic impact that's already being felt because of inflation and high energy prices, let alone this rising cost of capital.
Congress is, members of Congress are most interested in getting reelected. And of course, we've got an election coming up in November. If we go into recession, with a negative GDP number, and that's in the media and in the headlines and what everyone's talking about, doesn't the pressure get on Congress like right away of, oh, we need to do something. We need to, increase unemployment benefits, increase food stamps, maybe a round of stimmy checks to everyone's mailbox before the election hits. Does Congress get some pressure to maybe spend some money that then the Fed has to monetize?
Well, the window's closing rapidly. I mean, we're almost at August, and the election is early November. So they're running out of time to put together any legislation that would offset any economic downturn.
Yeah.
Keep in mind, after Labor Day in the US, all these politicians are going to be out campaigning.
Yeah.
They're trying to again get a piece of legislation together that's going to get support. Is going to be tough. And the criticism, I mean, even Joe Manchin understands that you don't cure inflation by sending people out more money. You only exacerbate that inflation. So he alone, I think, has killed the possibility of at least the Democrats that still control DC at the executive branch and obviously the congressional side. They have been stopped by Manchin in spending more money. So it's not going to happen, realistically speaking. And shifting back to the Fed, it was Manchin himself that wrote a letter. He was the only one in Congress that wrote a letter to Jay Powell. I think it was some point in 2021, can't remember exactly when, complaining about this brewing inflation problem while Powell kept talking about transitory. Well, you can be sure with the unemployment rate likely going higher, there will be a point when the letters to Powell will be, my constituency is losing their jobs. You have to do something about it. Yeah. Unfortunately for Powell, that will likely take place with inflation still well above 2%. That's going to make his job even more difficult. And that'll be the stagflationary type environment that we're already in, but will further tighten the screws around him.
I think a lot of, we're Wall Street Silver. We care about silver and gold and how it responds to all these different variables in the economy. And that's what a lot of us are thinking is going to happen is when the Fed pivots back to easy money or lower interest rates, it has to ignore inflation. That'll be the trigger for when gold and silver fully launch, because then the Fed's credibility to fight inflation evaporates at that point. I mean, is that a trigger you think is relevant to be watching for at this point for gold and silver investors and the mining stocks and things like that?
And for the dollar, because the second the market sniffs out not rate cuts, but just a pause. The pause is going to be even difficult because let's just say we get that 50 basis point September hike. Well, September is when QT doubles in size. So how the Fed's going to manage that? That they're conducting policy with their fingers crossed that somehow they can aggressively tighten, see a sharp fall in the rate of inflation without causing an economic earthquake and not killing off the markets as part of that. But again, that's just a fingers crossed type policy, just as when they were easing, they had fingers crossed that if they threw everything against the wall, that somehow that would save the economy. But of course, we know they overdid it. So they're going to overdo it on the tightening side, just as they overdid it on the easing side.
All of this seems like it's about to come to a head in September, the end of September at the latest, right? That's 8 weeks away before a lot of stuff actually either has to happen or fall. It seems like we're on a deadline, right? When all this happens.
Well, I think it will, because they're going to get to that 3% Fed funds rate that we talked about with another 50. So at least from that perspective, they will have gotten to around the level that they are more comfortable with, even though that level will still be below the rate of inflation. It would still be the first time in 40 years that a rate hiking cycle took the Fed funds rate above the previous peak of the rate hiking cycle.
Mm-hmm.
You know, each rate hiking cycle ended up below. So if they are successful in raising even 25 in September, that will break that 40-year pattern, but it would only break it modestly. There's not much more they can do above that. But I think what we're also sort of getting to here is that the Fed will end its rate hiking cycle, and we'll have to see with QT, it's probably below the rate of inflation. So real rates will remain pretty negative for a period of time, which also obviously is historically a good support for gold and silver. And like I said, once the market sniffs out a Fed pause, or at least starts to price in at some point while other central banks are tightening, maybe that could cap this pretty ferocious rally in the US dollar, which would also be good for the metals.
Well, on that note, thank you very much, Peter, for joining us. We appreciate it. And we're going to have you back in the next 2 or 3 months to, probably in September, I'm going to want to talk to you again and see how this all plays out.
I'm sure there'll be plenty to discuss then.